So we're going to start off with the underused housing tax update. There's been questions on that. I'm going to talk about the new enhanced trust reporting requirements, fast deadline approaching, and I'm going to touch on the new intergenerational transfer rules for shares of a family farm or small business corporation, which would be effective Jan 1, 2024. This is the disclaimer, of course, folks, that all this stuff is general information for your education, but you should not be acting upon it and taking it as specific tax advice. You really have to see your own tax advisor to do so. So a disclaimer is acknowledged, and we move on. So underused housing tax, quite a boondoggle, everybody knows. So we had a 22 filing deadline for the 2022 calendar year that was extended to Halloween, how appropriate, October 31st, 2023. And then on October 31st, 2023, so on that exact day that we thought we had to have all these 2022 underused housing tax returns filed, or UHT returns, the government nicely announced an extension to April 30th, 2024. So there's still time to file if you haven't. That's the important note to make. And there is no exemption for 2022. 2022 still must be filed. There's been pushback to the government to expand the exclusion to 2022. That has not happened, okay? So the other thing that, there we go, now it's moving. The other thing for 2023 and future years, so now what? So we had a fall economic statement in November, and they proposed to expand the definition of excluded owners. Those are the folks that don't have to file returns. Canadian citizens owning a property, for example. So they've extended that definition to include all these specified Canadian corporations, Canadian trusts, and Canadian partnerships. So all of you out there who are Canadian citizens owning companies, Canadian citizens, partners of partnerships, Canadian citizens, beneficiaries of Canadian trusts, you were filing returns if you had residential houses in those entities that met the definition and had to file an underused housing tax return. No tax owing, but you had to file because there was a penalty. Those are going to be exempt from filing. Don't have to file for 2023 and beyond. Now, those changes were announced, but not enacted. There is no legislation even in place right now for the House of Commons and the Senate to pass to make this exemption law. Now, what sort of supports the position we don't have to file is very recently the CRA issued their new UHT return. And if you read the new UHT return down in the fine print, it says for 2023, they've expanded the definition of excluded owners, people who don't have to file, to include all these entities. So we're pretty comfortable in saying that there is no filing obligation for 2023 and future years if you fall into those categories I just discussed, okay? So that's good news. Bad news is the trust reporting. This was announced a number of years ago. People sort of, maybe ignored it because it kept getting pushed off. Now it's here. It's law. It applies for all trusts with tax years ending on after December 30th, 2023. So every trust with a December 31st, 2023 year end, which is most trusts, to be honest about it, will possibly have a filing requirement. And you have to file a trust tax return, which is called a T3, and there's a new Schedule 15 in this return that they want a lot of personal information about the people involved in the trusts. Now, these returns for 2023 are due, they're due 90 days after, but because it falls on a weekend or whatever, and there's a holiday, the 2023 returns fall on a due date of April 2nd, 2024. I've added some links there. One of them is the Canada Revenue Agency website. They do have quite a bit of information right on their own website on these new trust reporting requirements. So if you go there, you can read up on it. If you go to bdocanada.ca, our bdo.ca, sorry, our external website, we have a very good article on the trust reporting rules, and so do a lot of other firms if you're looking for some information. What's the change? The change is basically all trusts, unless very specific conditions are met, will be required to file a return, whether or not there's any income or tax owing. It's an information return for the most part. The government wants to know, just like UHT returns, right? No tax owing, but they want it to know. You got to file this return and you have to fill out this section 15, schedule 15, sorry, to report specific information. So you might be sitting there saying, trusts don't apply to me. I don't do anything with trusts. It's not my thing. I don't have any. They've expanded what is a trust, and it includes what are called bear trusts, and I'll get into that in a minute. We see those a lot in agriculture. They will be subject to the new trust reporting rules also. So we have a lot of trusts that need to file for the first time, never filed before because didn't have to, no income, didn't own anything. They need to get a CRA trust account number. That's generally easily done through the CRA website, and you get a trust account number, fill out the tax return, and file it. The legislation refers to express trusts. These are trusts that somebody has settled or created on purpose. And there generally has to be three certainties to have a trust: the intention to create a trust, you're putting some property in trust like real estate or shares, and there's beneficiaries. Okay. Common types of trusts, some people use them in their family planning. They may have a family trust that owns shares of their family business corporation. They may have a family trust that owns some real estate, owns a cottage, farms, whatever. Somebody who's passed away and has an ongoing estate or trust, there may be a trust filing obligation there. And then there's these bear trusts, and bear trusts are arrangements where there's somebody who's the trustee who holds legal title to the asset, but that person really is an agent for the beneficiary. So that trustee holds legal title only, but all instructions around the property, all directions around the property, the beneficial ownership of the property lies with somebody other than the person who has legal ownership. That's a bear trustee. So think of a company holding legal title to a farm, but it's holding that farm on behalf of maybe another farm company for some reason. That would be a bear trust relationship, even if there is no trust document in place. Okay. So there, examples of bear trust: corporation holding legal title of a farm and another corporation's the beneficial owner. We see that in tax planning where people are reorganizing their farm corporations and they may have used this parties on legal title of properties are different than who the true beneficial owners are, simply to avoid mergers of properties, right? Farm one is beside farm two. Farm one is in husband and wife's name. Farm two is just in husband's name to avoid those properties merging. Is farm two really just husband's? He's the only one on legal title, or is he holding it in trust for himself and his spouse? Okay. In trust bank accounts for a child and a grandchild. You see that once in a while. Will somebody set up a bank account? People who've added children to the legal ownership of their real estate, say their house or their investment accounts or their bank accounts, and they've just added them to the legal ownership of that to simplify their estate administration, maybe minimize probate, maybe help pay the bills, right, and do the banking because maybe mom and dad are up in years and they're helping out. But who's the real owner of those bank accounts and investment accounts? 99.9% of the time, everybody involved will say it's mom and dad's money or mom's money or dad's money. I'm just on the account to help out as the child. That again is a bear trust type arrangement. Parents, we've seen this a lot. Parents add it to title of a child's house to qualify as a mortgage. Most of the financial institutions are saying mom and dad co-signing is not good enough. Mom or dad have to be on title to the house that the child's buying or building. So mom or dad will go on title for say 1% or 0.1%. And if they're still on there, they were still on there at December 31st, 20, or anytime during 2023, sorry, then there's a bear trust arrangement there and a filing requirement. Someone holding legal title to property on behalf of a group of owners in a joint venture. We see that sometimes where one party in the joint venture is the legal owner of the real estate. They're the ones on title, but they're holding it pursuant to a trust agreement or joint venture agreement for a bunch of other people. So again, the concept being the legal owner is different from who the real beneficial owners are, then you probably have a bear trust arrangement. I'm not saying it's absolutely certain, but that's a good sign there is one, right? And so there are some trusts that are exempt from providing all this extra information, and I'll get into what that is in a second. But if the trust has been in existence less than 3 months at the end of the year, that's an exemption. If the trust is holding certain assets with a fair market value that does not exceed 50,000 throughout the whole year, so throughout all of 2023, didn't exceed 50,000, but only certain investments qualify, cash or near cash, and publicly traded securities, for example. The Canada Revenue Agency, CRA as we call them, has stated that qualifying securities does not include GICs. So if there's GICs in the trust, it cannot use the 50,000 exemption, or gold or silver coins. Back in the old days, a lot of trusts were settled with coins, precious coins, be it a gold coin or silver coin from the mint. Those would not qualify for the 50,000 exemption threshold. Graduated rate estate, somebody passes away, generally the first 36 months after they die is considered the graduated rate estate years. After 36 months, it's not anymore. So then you may have a filing requirement if that estate is ongoing. Or qualified disability trust, pretty self-explanatory. If somebody's disabled and there's a trust for them and they designate that trust as one of these qualified disability trusts, there's no filing obligation for the Schedule 15 information. Trust can be exempt. So if you don't have to do the Schedule 15, which I'll get into, and you don't otherwise have income or any dispositions or anything like that, you may not have to file a T3 at all. But to be honest, if you're in doubt at all about whether you need to file for a trust or not, it is better to file to avoid the potential penalties, which I'll get into. And if you're unsure there's a trust, this is really an area of legal advice versus accounting advice, which is a bit frustrating for us accountants, but that's where we're sitting with this. So what is this Schedule 15 that they want as part? Why do they want all this information? Because we got all these bare trusts. We've got a pile of them that we're listing out. All our offices do. No tax owing. There's no tax. They just want all this information. What is it they want? They want to know who the trustee is. They want to know who the settlor of the trust is. They want to know all the beneficiaries. They want to know if there's a controlling person who can exert influence over the trustee. And what do they want with it? What detail do they want of all these entities? They want to know what they are. Are they a natural person? Are they a corporation? Are they trust? What type of entity is each of these things that are part of the trust? What is their full name? What is their date of birth if they're a natural person? What is their tax identification number? If it's a person, it's a social insurance number. If it's a corporation, it's a business number. If it's a trust, it's a trust number. Where do they reside? What country do they reside in? Do you have beneficiaries that live in another country? They want to know that. And they want the full mailing address of everybody involved. It's a lot of information. And that's just in one part of the schedule. At the very bottom of Schedule 15 is a Part C, they call it, where if you have a trust where you have potential beneficiaries, grandchildren who aren't born yet, great grandchildren who aren't born yet, companies that may become beneficiaries based on the trust terms, anything like that, you have to put in that description down in Part C of the form so that somebody could determine who or who wouldn't be a beneficiary. So basically you're copying the beneficiary provisions from the trust deed, if there is one, or from the will, if it was somebody who passed away, into this part of the Schedule 15, Part C, Schedule 15. So they want a lot of personal information. As a trustee, you must make a reasonable attempt to get all this information for Schedule 15. And if you can't get it, you got to document the efforts you made. You have to make a reasonable attempt to get the information. If you do, you should not hopefully be subject to the more severe penalty. So where the failure to get this information is deliberate, which means you made no effort or made minimal effort, or due to gross negligence, which means you just ignored this filing requirement, they can levy a penalty. And the penalty is the greater of $2,500 or 5% of the market value of the assets held in the trust. This penalty is not based on tax because a lot of trusts will not have tax owing. It's a very significant penalty. If you make a good faith attempt to get all the information they want, fill it out the best you can, document. If somebody refuses to give you the information or you can't find the beneficiary, you should not be subject to this higher penalty, we think. You've done your work and there should be a due diligence defense. But somebody who ignores it, so somebody who has a farm held in a bear trust, the legal owner is different than the beneficial owner of a farm. It's worth $5 million and they just ignore it and don't bother. 5% of a $5 million farm is $250,000. That's the potential penalty we're talking about here. The Canada Revenue Agency says it will waive penalties for bear trusts for 2023 only, not for future years. And unfortunately, right now, this waiver does not apply if you knowingly ignore the rules, which is the same as gross negligence. You just don't abide by it. Then the more stringent penalties can still apply. So I'm not trying to fearmonger, but this is a very significant penalty that's based on simply not filing and not based on any kind of income or tax owing. Who has to report? The trustees are responsible for this. So if you're a trustee of a trust, so the legal title owner of a piece of real estate who holds it for somebody else who's the beneficial owner, that's the trustee. If you have a family trust, then you easily can tell who the trustees are. A will, the trustees are usually somewhat similar to the executors. But anyway, they are responsible for filing. There's lots of uncertainty in some cases whether a trust truly exists. In other cases, yeah, it's simple. There's a trust. But in some cases, we're not sure, we're not clear. And it's really putting the accountants in a difficult position because we're usually the ones filing all the tax returns. But we may need to get legal advice or get your lawyer involved to determine, is there really a trust relationship here or is it something else? The other problem with these rules is they want to know information about the settler, as I noted earlier on the slide, and this is an expanded definition. So they want a listing, a name, address, social insurance number, whatever, dates of birth of any non-arm's length person who's ever lent money to the trust or transferred money to the trust. They're going to consider them a settler. And then, as I mentioned before, even if you have anyone who's beneficially interested has to be reported. Some of the trust terms are very broad and you could be reporting a lot of entities. So if you have a trust that says any corporation controlled by a beneficiary named above can be also a beneficiary, any corporation owned by your kids or your grandkids would have to be listed. Or if there's another trust that could be a beneficiary, then that has to be listed. So we're seeing trust deeds, old trust deeds where people added a lot of family members as beneficiaries, far-flung family members in some cases, and they're saying those people don't even know they're a beneficiary. We've never given them anything from our trust. We don't want to approach them for this information. Our comment is you have to make a reasonable attempt to get that information to avoid the penalty. There's no skipping that. Now, if you go ask somebody for that information because they're a beneficiary of trust and they refuse to give it to you. We've had situations of family disputes and they refuse to give it to you. Simply document the efforts you've made to obtain the information. So you have a due diligence defense. Beneficiaries that are contingent. This is that part C I referred to where we just put in the wording of beneficiaries because some of them might not even exist yet. You might have wording in a trust. If none of the beneficiaries are live, then it goes to their issue, which is basically their children, right? And if failing that, goes to your siblings. And if your siblings aren't alive, maybe it goes to their issue, which are your siblings' children. Those people might not be alive. You don't know who they are. So it's sort of a description of who the beneficiaries are that we would put in the part C of the schedule where they want that wording and list the trust terms. And again, I can't overemphasize, if there's a known beneficiary out there, you have to make a reasonable attempt to get that information and make very good notes that you've done so, particularly if you can't get the information for some reason or another. So I'm going to back up on that. I'm going to go into the next topic, and I went through that quickly, and we'll have Q&A, I guess, at the end, Ben, I assume. This is fast approaching, and it's frustrating as a tax professional accountant. In my opinion, we have been given not much guidance or support from the government entities who are responsible for administering these things. Lots of questions to the Canada Revenue Agency, not a whole lot of guidance, to be honest about it. So, we're sort of flying by our seat of the pants for some of it. And But the bottom line, that all the tax professionals are saying, if in doubt, file. But at the same time, you don't want to file for a trust if a trust doesn't exist. And if you're not sure, then you need to get some good advice to figure that out. And it has to be fairly quickly because all this is due by April 2nd. So the next thing I was going to hop into is the intergenerational rules. So a little history here. So back in June 2021, we had what was Bill C-208 was passed, and some people on the call might know that terminology, Bill C-208. It's been thrown around quite a bit. And they were very broad rules. It was a private member bill, surprised everybody it got passed in the law. Very broad rules, but it would allow parents to sell shares of their family business corporation, like a family farm corporation, to a company that's controlled by their children, one or more of their children. Before this law came, you could do it, but you didn't get very good tax outcome at all. It was a very bad tax outcome. This way you could do it, sell your shares, use your gain exemption for qualified farm property. Kids get to use a corporation to buy mom and dad's shares, which is always more tax efficient. So a good outcome. But the rules were very broad and could be used to abuse those provisions. Somebody could use it in a very abusive manner. The government didn't like it. Private members bill, we're going to change it. Took them till March of 2023, long time, to come out with draft legislation to tighten up these rules. And there's two streams now called an immediate transfer stream and a gradual transfer stream, and I'll get into those in a minute. And then we had some legislation in August, changed a bit of the draft legislation from March, and then we had some final draft legislation the end of November, a few more tweaks to the rules. That became what's known as Bill C-59, still working its way through the Senate. It needs to go back to the House of Commons. Not yet law, but it will be, and it'll be effective for Jan 1st, 2024. The legislation is really trying to dictate to parents and their children these three things. What is required for a transfer of economic interest in the family business? What is required to ensure there's a proper transfer of control of the family business? And the transfer of the management skills and management decision-making of the business. So getting beyond tax, right? This is in the Tax Act, but this is much beyond tax, where they're dictating to parents how long you're allowed to give management services, how long you can control the business. So it's very, very broad and encompassing. There's some key terms here to consider, and it's getting technical, I apologize. But there's things called shares of a specified class. Some of you might know these better as the free shares. So these are the shares when we give to mom and dad, when kids are coming in to own part of the family company, and they don't have votes, and they're fixed in value, and they have a dividend. They can have a dividend, but it's not higher than the government's prescribed rate. So it's like debt, but they're shares, non-voting freeze type shares stuck in a value at the time we did the freeze. The definition of children's here only to say it's expanded for the purposes of these rules to include nieces and nephews. So now we have the ability to include nieces and nephews in these rules for the intergenerational sale of shares of a family farm corp or family business. And it also is the extended definition of child, which simply means that if a person's spouse dies, they are still considered to be the child of their deceased spouse's parents. So if somebody was transferring a farm operation to their son and daughter-in-law who's and their child had already predeceased or passed, unfortunately, the rules can still be used. And management, I'm going to talk about this a little later, and I'll put it up again, but they have defined what they see as being management. And they say it refers to direction or supervision, but not providing advice. I don't know how CRA is going to audit that. I have no clue how they're going to walk into and say, we think mom and dad are giving direction and supervision, which is offside, and it's not advice. Because you can give advice, but you can't give direction or supervision when we get into the rules. So very, very odd. The corporation that's being sold, the subject corporation, that's the operating company. That's the one that mom and dad own. So mom and dad, the parents, are selling a company. The purchaser company is the company the children or child control. They set up a company to buy mom and dad's shares. So that sounds simple enough. Their company is going to buy mom and dad's company. Then there's this relevant group entity. So it gets a little hairy again. They're basically saying, hey, if there's any other business entity out there that's relevant in determining whether the shares that mom and dad are selling are qualified small business shares or qualified family farmer fishing corporation shares, that entity gets sucked into this at the same time, because we're not going to let you do it again on a relative entity. So we got to be very careful when we're looking at this as to which entities are involved and which are not. So a picture sometimes helps a lot with this. So here's mom and dad's company in the middle. The subject, the shares of the family farm company. The child set up a purchaser corporation here. Parents sold their shares to the child's company, maybe used their gain exemption, right? And the child's company owes money or has a promissory note owed to mom and dad. Fairly simple. But if mom and dad own another company or another entity that has assets that are relevant in determining whether the shares they sold are qualifying, that entity has to be included as part of the deal. And let's say the shares of the company mom and dad are selling happen to own another company that carries on an active business. That company is part of the deal. But there might be another company that mom and dad's company owns that doesn't carry on an active business, and that's not considered a relative group entity. So we're getting a little technical here. So just the bottom line is, as tax professionals, we got to work through these rules, make sure that we got all the right parties involved in the transaction that need to be, so we're not offside. So you have, as the parent selling the shares, you can never have used this exception before, and they changed at the end of November to saying if you use the old rules up to the end of December 2023, you're fine. You can use these rules again, the new rules. Before it was, if you had used the old rules before, you were done. But now it's, you use the old rules, okay, that's fine. We'll still let you use the new rules once. Now you can only use it once with respect to shares from any particular active business, and anything that is relevant in determining again whether those shares qualify, you can only use it once. So it's very important that you can't say, oh, I'll do these rules for part of my shares now, mom and dad, and down the road I'll do more of the shares under these rules for the same company. No, that doesn't work. So the vendor must be an individual, no big deal, can't be a trust. The purchaser company got to be controlled by the kids, one or more kids age 18 or over, fair enough. The shares we're buying, that the kids' company's buying, qualified small business shares, shares of capital stock of a family farm or fishing corp. Again, those are defined in the act for the capital gain exemption. So fine, we work through that, make sure we got qualifying shares, as we call them. Then they get into the economic interest. So at all times after the parents sell the shares, or a parent, the parents, mom and dad, because it says and spouse, together with a spouse, cannot own indirectly or indirectly 50% or more of any class of shares other than these freeze type shares, what we call specified class, or 50% or more of any class of equity interest in anything that's a relative group entity, an entity that's relevant to determining if the shares that mom and dad sold qualify. And that can be shares of other corporations, a partnership, a trust. So again, we have to be very careful. We're covering off all the entities, but you, as parents, you're there. You restrict it right away. You cannot own 50% or more. And within 36 months, mom and dad, after you sell, you cannot own directly or indirectly any shares of either of the companies. The company is sold, kids' company, obviously, other than, again, than these freeze type shares, like debt-like shares. And you can't own any equity interest other, again, than these freeze type shares and any relevant group equity entity. So the government's really pushing, right, to get the transfer over fast to the kids. There is a gradual method I'll get into a little more. This one has one extra condition that the immediate one doesn't. It says to mom and dad, hey, within 10 years, whatever you own in the companies and the relevant group entities cannot exceed 50% for farm corps, 30% for other qualified corps of the fair market value of all the interest you had just before you sold to the kids. So this one's dictating that within a 10-year period, you have to drop below those thresholds, be at or below those thresholds. So you can imagine the work to monitor this now going forward if you're using the gradual method for a 10-year period, right? So it's not easy stuff. Then they're getting into control, and they're saying at all times after the sale of the shares, the vendor with their spouse, so mom and dad, in my example, they simply cannot control the corporation they're selling, the subject corporation, OPCO. They cannot obviously have any control of the child's corporation, the purchaser's corp, and also any of these relevant group entities. And I think that's going to be the surprise to people as to what other entities might get sucked into that. For the immediate transfer rules, where we're following the immediate stream, they're calling it, the control you have to give up is both legal and factual. So legal being shares that have voting control, factual being you're not in there on the directors, you don't have a large debt holding, you're not using your family influence to exert what they call factual control. So that gets difficult too, right? That's a gray area. Legal control we understand because that shares with voting control. For the gradual transfer, which is the 10-year one, you simply have to give up the legal control and not necessarily factual control right away. But then there's another rule that says, hey, from the time mom and dad sold the shares, the children or group of children have to legally control the purchaser corp. One of them has to be active on a regular, continuous, and substantial basis in the businesses. And each business that's carrying on an active business has to continue to carry on an active business. And for the immediate transfer stream, that's for at least 36 months. For the gradual transfer stream, it's the later of 60 months after the time of disposition and the final sale time. So the final sale time was referred to in an earlier slide. That's that up to 10-year period you have to get below the 50% threshold for the family farm corp. So, these conditions are getting a little hairy, right? There's a lot to think about. And now they do have some exceptions to these things. And just to go through them quickly, they're saying, hey, if all the children sell all their shares to an arm's length entity, even before that 36-month period is up, say for the immediate one, or before the periods are up that are supposed to be there, they're saying, hey, that's fine. We'll deem them to have met those rules, those three conditions. So if we go back, it's basically these are the three conditions we're referring to around the 36 months and the 60 months. So they're saying we'll deem them to have those if they've sold all their entities to ownership, to an arm's length party. What if you sold the shares to a company owned by one or two of your children, but there's other children you have and now they want some ownership? That would be an exemption too if those children came in to buy shares. So that's the second bullet there. The other exemption is, a naturally good one. They should have been there in the first place. What if a child unfortunately passes away or has a permanent disability that is prolonged? There should be an out there. They shouldn't have to meet those requirements because there's likely a sale going to happen. The last condition on that previous slide of the three conditions was that these companies had to continue to carry on their active businesses for the 36 months or the later of the 60 months and final sale time. There's an exception there, which is an unfortunate exception, but it's there in case these entities go insolvent, declare bankruptcy, go into proposal. Then they don't have to carry on their business anymore because they're selling their stuff off to satisfy debt, right? Then we did economic interest, we did control. Then there's management. So those are a lot of rules we went through, and I know it's a lot of stuff. But now they say, okay, what about the actual management of the company? So within the specified time, the parents, vendor, and the spouse have to take reasonable steps to transfer management of each business carried on by the farm corporation, carried on by any relevant group entity that's part of that group. You have to transfer that to the child, or at least one member of the group of the children who are actively engaged on a regular, continuous, and substantial basis in the business. So this regular, continuous, and substantial basis requirement for a child, I've referred to that before. They want to use these rules for transition and succession planning. They want children who are actively involved. The old rules, the children didn't even have to be involved. These ones you have to be. And then what they're saying to the parent, the vendor, and the spouse You have to permanently cease to manage each relevant business of the farm corporation you're selling, for example, and any of these relevant group entities, whoever they are, that have to be included. You have to permanently cease to manage within 36 months if it's the immediate stream, and within 60 months if it's the gradual stream. And again, management refers to direction or supervision, but not advice. So somehow you have to be able to prove within these timeframes that you have stopped providing direction and supervision, but it's okay if you give advice. So everything you do after 36 months or 60 months, you're going to mark it down as being advice and not direction or supervision. I find that odd, and I don't know how the government's going to audit that. I really have no clue, and nobody at the government can tell me how they're going to audit that. So go figure, right? Again, there's some exceptions where these conditions of management that I just talked about, 36 months, 60 months, what if management doesn't cease properly or something goes wrong? There's some exceptions again. The children have disposed of all their shares to an arm's length party. The children have disposed of their shares, say, to another child within the family. One of the children who was actively involved died, unfortunately, or has become subject to a severe and prolonged physical or mental impairment. So there are some exceptions there to the rule that makes sense. Now, the whole interesting part of this, say you work through all this and everybody's comfortable with all the conditions and the parents are fine meeting all the various conditions of either the immediate or gradual transfer, because there's a lot of conditions there, right? You got to do this within so much time and that within so much time and give up management, control, economic interests. You got to do all that, but you know what? The children can mess it up too, because these things have to last for a number of years. There's a 36-month requirement I talked about. There's a 60-month requirement I talked about. There's a 10-year requirement on the gradual one I talked about. If you don't continue to meet those conditions with it, those expand blows up. And if it blows up, that's a massive tax bill likely for the parents who sold the shares, because now the parents will likely be considered to have a dividend that's fully taxable rather than a capital gain. So what are they doing here? They're saying the parents, the vendor, and the children, and every member of the group of children who are involved, they have to jointly elect and file this election with the tax return in which the sale occurred. So if the sale occurs in 2024, it's got to be filed with the 2024 tax return. You file this election, it's going to deem the parent, the people selling the shares, and the child company that's buying the shares to deal with each other at arm's length. That gets you the capital gain and the gain exemption, right? You got to file the election. You have to. What it also does is it says to the children, you are jointly, severally, and solitarily liable for any additional income tax your mom and dad might have who sold the shares of their company to your company. Any of that additional tax that's greater than the tax would have otherwise been if the conditions were satisfied. Because if you think about it, if a child sells the shares within 2 years and meets none of the exceptions, maybe they've messed up the whole thing and created a massive tax liability for the parents, then the children will be held jointly and severally liable with the parents. Doesn't get the parents off the hook, unfortunately. And then I think this becomes to be a discussion with the lawyer and legal advisor. Should the children be legally indemnifying the parents against the additional tax? Something for discussion, I think. And if you use these rules, the government said, hey, there's all these extension of years, 36 months, 60 months, all this stuff that's happening. We need, as the government, as the Canada Revenue Agency, we need more time to be able to audit these things, and the years can't become what we call statute barred, which means the government can't go after them. So they're saying, you know what, we're going to add more years that we can go and look at somebody's tax return if they've used these rules. So if you use the immediate transfer stream, there's another 3 years added to the normal 3-year reassessment period. So you're up to 6, basically, right? And if you use the gradual one, there's another 10 years added after the normal 3-year reassessment period. That's a long time to be added to your tax returns to keep them open, so to speak, for CRA to reassess and review. But that's the rule that's there. The good thing they did change is if the parents sold shares of their company to a company owned by their kids, under the old rules, all the parents could get in that case is like 5-year capital gain reserve. Because usually the parents aren't taking all the money up front. Obviously, sometimes they're spreading out payments over a number of years. The most we could do was 5 years before in that example. They've changed to 10. So if the parents take payments on the amount owed to them by selling their shares to the child's company, and the payments are going to be extended out over 10 years or longer, you can spread the gain out over a maximum of 10 years. And it is an optional reserve, so at least, some years if you don't need it, you don't take it. Other years you might, but it's a good thing. And the other thing with the new legislation, which is good, which we can't do under the old legislation when we used it for clients, is we can now do other reorganizations, amalgamations, and windups, which in our world is important to do with some of these structures. So that's now possible. Okay, where was I? Oh, that's a lot of stuff, folks. I know, and maybe I went through it, fairly quickly. But then that leaves us a bit of time here to answer some questions.
Thank you, Kurt. That is a lot of great information. And I do see some questions in the chat. Just a reminder, if you do have questions, type them into the chat and I will read them out loud. So I'll start from the beginning. There was a question about whether the PowerPoint can be shared. I assume, Kurt, you're okay with us sharing this PowerPoint?
Absolutely. Yep.
Okay,
yep.
Great. And there will be, this webinar is being recorded. Yeah, I believe it'll be available on OFA's YouTube channel and on our website. So the next question, now we're getting into some of the questions starting with around the trust.
Okay.
The first question is, does an RESP or ESP qualify as a bare trust?
No. So there's a list of trusts that are exempt from filing. I did not include them all, but any RESPs, registered education savings plans, registered retirement income funds, RRSPs, the new first-time home savers accounts, FHSAs, all those registered type plans are exempt from trust filing. There's no filing there required.
Okay, great. There's a bit of good news. Joan writes, I relate to her, how she begins this. She says, where to begin? How to determine if one must file a tax form and what type to file, either lawyer or accountant or both? What steps should be taken?
Yeah, so that's a good question. So in my practice in Midwestern Ontario here, the accountants file the tax returns. Our lawyers that we deal with all locally do not file tax returns. We do the tax returns. Where we need the lawyers' help, though, in some of these trust cases, it is a question of law. Does a trust really exist or not? And that's only if you get into a situation where you're really unclear. And so I've talked to a lot of lawyers, obviously. But where it's very clear there's a trust. So for example, we've had a company set up to buy a farm, and that company's only holding legal title to the farm. And it's holding that farm for another farm company. It was because it was part of a land transfer tax plan. I know there's a bare trust there, and we actually have a simple 2-page, 3-page bare trust agreement. Then as accountants, we would do that filing. So if you know there is a trust, then you should be, I think, seeing your accountant to do the filing and get that done. So what we've done with our client base, as we've been asking our clients, we sent them a lot of information, but now we're into personal tax return time, and we see a lot of them in person. And we're asking, is there something you have that's legally owned by somebody, but it's really beneficially for someone else? And what might be a good giveaway actually is if you're looking at the tax slip. So, if you get your T5s for your interest in T3s, and there's more than one name on the slip, but there's only one person reporting the income, like the parent, but there's a child's name on there to help with administration and paying the bills, you likely have a bare trust there. I would say you do have a bare trust there, and you should be filing, because 5% penalty on the value of the assets held in trust is just too much risk in my mind. So
Okay, great. Thanks for that, Kurt. So fair to say, if you're confident you have a trust, talk to your accountant. If you're unsure, talk to your lawyer.
Yeah, and if you talk to your accountant first and you're not sure, then, if your accountant can call the lawyer and have a chat with them. We had one situation where we weren't quite sure because it's an ongoing estate, but there's litigation involved, unfortunately. So we reached out to the lawyers of the estate to say, hey, we're not sure whether there's a filing requirement for certain people to be added to. We know there's a filing requirement. We weren't sure who should be all added to the list. That's the other thing. What's people's names and addresses and socials, insurance numbers are we throwing on this new schedule? If you don't have to throw them on there, you don't want to, I guess, right?
Yeah.
So even that question, we've had to go to lawyers a few times. So if in doubt, certainly talk to your accountant, and your accountant can either talk to your lawyer or direct you to talk to your lawyer if you're unsure. Yeah.
Great. Thank you for that. James asks, how can you get rid of a trust?
Yeah, that's been asked a lot, James. Oh my gosh.
Yeah.
Oh, or not only that, how do you get rid of beneficiaries? Because people added everybody under the kitchen sink as a beneficiary. That again is a good legal question, but a trust, if it depends the type of trust there is, but trust can be wound up. Trust can be wound up in a tax efficient manner. So you need to get some tax advice, accounting advice, and some legal advice. So for example, I had a trust wind up last year. It sort of had ran its life. It had minimal assets left in it. We basically got everything out of the trust that was left, and we did it properly in a tax efficient manner, and then told the client's lawyer to dissolve the trust. The trustees pass resolutions dissolving the trust, and we do a final trust tax return. And we say on the tax return, there's actually a question. It says, is this the final tax return for the trust? And you click yes. And when was the trust dissolved or wound up or whatever the wording is, and you put in the date and you file that, and trust is gone. So just need to get some help to do that. Yep. Yep.
Okay, great. Our next question is from Susan. She says, CRA suggests you send a letter with a specific details to help establish a trust account number for a bare trust, such as a bank account with a parent. Can the trustee sign and issue the letter on their own, or does the settlor or beneficiary need to sign as well?
I would think the trustee should be able to. The trustee technically is the one that manages the assets on behalf of the beneficiary. The settlor is the person who puts the assets in the trust in the first place. But when settlors put assets in a trust, they're the ones appointing the trustee to manage the trust. So with a bare trust, let's say I'm on title for the farm, and my mom still lives on the farm. She does, but let's say I was on title and I'm holding that farm under a bare trust for my mom. My mom would be the settlor because it's her farm that went into the bare trust. I would be the trustee because she stuck my name on legal title to the farm, and she would be the beneficiary because I have agreed that I'm holding that in trust for her, and she's really the 100% beneficial ownership. When you go on the CRA website, if you can get the trust account number electronically, and you don't have, there's this place where you can drag and drop in the trust deed, and then that's good. If you have a bare trust agreement or otherwise have a trust deed or a will, you can drag and drop it in. If you have no trust agreement, and sometimes with bare trust there simply isn't, we are told you can type simply in a good description of the settlor, trustees and beneficiaries when you're applying for the trust account number. So signing by the trustee should be, in my mind, sufficient. Yeah.
Great.
Yeah.
Rob asked, and I believe we're moving now into some questions related to intergenerational transfer rules. Can you still bring a child into the company and split responsibility, or do they have to buy outright?
Buy outright. Okay. So yeah, so what you're asking about is these new intergenerational rules. And there's a lot of conditions there, and I get it because it's I have a trouble remembering them all. There's so many of them. I have a nice sort of flow chart that I use. But you have to, if the shares qualify, the child has to set up a company to buy them. Remember, like part of the economic interest is right after mom and dad sell, they can't own 50% or more of the shares of any class other than the free shares. So mom and dad are really what the government's doing is saying we're trying to freeze mom and dad out, give them just free shares. I don't know that, when the question is, do they split responsibility? Like we have to look at the transfer of the economic interest, we have to look at the transfer of control, and we have to look at the transfer of management. So if you go through the slide deck, there's those three. When you say responsibility, if you're talking management, remember we had that time frame where we said, hey, you got to transfer management either within 36 months or within 60 months, depending on the stream. And management is direction or supervision, but not advice. So as a parent, you can always provide advice, but they're saying within 36 months or 60 months, you cannot provide direction or supervision. And again, I'm not clear on how they're going to audit that or make sure that's the case. If you're talking about, can you own shares, parent? You can own these freeze type shares. But after 36 months, that's all the shares you can own is the freeze type shares, non-voting shares, fixed in value with a dividend rate that's set at the prescribed rate at maximum at the time of issue. That's really all you can have. And if you're doing the gradual method, then we have that extra 10-year rule that says, hey, within 10 years, all the value of everything you own, not just shares, but maybe promissory notes or shareholder loans, all that equity cannot exceed 50% of what you had at the time of sale to your child. If it's a farm corp, 30% for other corps. So, it's a long-winded answer, but really we have to work through all these. I think what we have to do as professional advisors is work through all these conditions with mom and dad and the kids. Like, I got a boardroom here with a big screen on it. I would basically be going through all this with the client, right? Going, here's the conditions we have to meet. Let's talk about them. Are you comfortable with them? Are you okay? Are we doing the immediate one? Are we doing the gradual one? Or maybe it's not the time to do it yet. Maybe we got to wait a bit before we pull that trigger to be able to meet all the conditions the government's now imposing to get the right tax outcome. So I'm not sure that answered the question, but I hope.
Yeah, it always depends, right? Yeah.
Yeah.
Great. Andrew asks, and I believe this is still related to the intergenerational transfer rules. If the farm property is rented out, is it still covered under these conditions?
Yeah, that's a very open question because there's a lot of rules around who is it rented out to, right? So if I have a company, if I own a farm corporation that owns a bunch of farms and it rents it to me personally, and I run my farm operation personally for some reason, that's good farming still. But if I own a company that owns a bunch of farms and rents it out to somebody who's not related to me or even to my siblings, that's just rental property. That's not farm anymore as far as the government's concerned. You're not the farmer. So it really depends. And sometimes we'll have situations where the clients have a farm land company. They have a company that owns a lot of farm real estate. They'll have a separate company where the operations are carried on, the cash cropping, feedlot, or whatever. And depending on the ownership structure of those two companies, that company renting the farmland can be a good company. It can be a good company. So it's really a technical thing we'd have to look into whether it qualifies or not, right?
Yeah. Okay, makes sense. James asks, do these rules apply if the son obtains farm shares personally rather than through a corporation?
Absolutely not.
Yeah. Great. Okay, guys, easy one.
Yep.
Always nice to get one or two easy ones. Michelle asks, this may have been mentioned, but do these time frames, and she's referring to the 36 and 60 months, apply to agreements that were made previous to 2023?
Previous to 2024, no. So the rules I'm talking about when the laws pass will be effective Jan 1, 2024. So lots of people, and sure some on this call did, a lot of our clients, a lot of everybody's clients, a lot of farmers and non-farmers with small businesses took advantage of what we call those Bill C-208 rules that came in place in 2021. They didn't have all these conditions, not even close to these kind of conditions and requirements. So for those rules, if you fell under those old rules, you're fine. You don't have this 36, 60 month, 10-year requirement added to that. Also, and just to reiterate, if you use the old rules to your benefit, which was great, you still are able to use these new rules now, because they did change that a bit in November to say, hey, if you've used the old rules, we'll still let you use the new rules once per entity or per group of related group entities kind of thing. Yeah.
Okay, great. And Joan asks, and I believe again referring to the intergenerational transfer rules, does this tax application discussion apply to an owner with a farm number versus a corporation? Not quite sure what she means, Joan. If you want to type any clarification on that question, we'll move maybe I think there's one more question, and then
Yeah,
we'll
maybe the clarity on that is the rules I'm talking about apply to shares of a family farm corporation or shares of a small business corporation. So this is all about shares of a company.
okay.
If you own your farms personally as a proprietorship, or you have it in a partnership, these rules aren't applicable to that. There's favorable rules for transferring farms to the next generation for proprietors and partnerships that have been there for some time. And you're selling the land, for example, to your kids, or you're selling them the equipment, the quota, you're selling assets, not shares of a company. There's favorable rules for that too. These rules are so the parents can sell shares of their family farm corporation, get their capital gain exemption on selling those shares, and get a reasonable tax outcome for the children, because they're allowed to use a company now to buy mom and dad's shares. That's what these are all about.
Great. Nancy asks, when mom sold the farm, we found a house in town and she added my name to the deed. Is that a bear trust?
I'm going to go out on a limb and say probably. So let's put it this way. Your mom sold the farm, moved into town, pretty standard thing. She put your name on the deed. I assume as a joint owner's right of survivorship rather than a tenant in common. So let's go with that. Maybe she did that. So when she passed away, you would get the house, or she trusts you to take the house and do whatever with it. But as you're sitting here, you're going, that's mom's house. It's all hers. She's the 100% owner. She takes care of it. We all agree it's mom's house. If mom were to sell it tomorrow, that's mom's money, not mine.
Right.
That's a bare trust. And so that's pretty common, right? People, as some seniors, as they get older and they start adding kids to title. To me, that would be a bare trust. Now, is there a bare trust deed, or sorry, an agreement? Ideally, there would be. They don't have to be complicated, a bare trust agreement, but ideally that there might be one. And if there's not, maybe you should get one. Because what you're, really off topic, you're venturing into a part of estate law that can get a little tricky, because when your mom added you to the deed, ideally she should have documented her intent, because we're seeing more estate litigation than ever. So, to play the devil's advocate, if a parent adds a child to the deed of a property and says to the child, this isn't really yours, it's mine, and when I die, you have to split it up with your brothers and sisters. Then we find situations where the parent dies and the person on title says, no, that was meant to be all mine, right? Because by law, it goes to the joint owner, and off they run to court and lawyers and accountants and all sorts of nasty stuff. So ideally, you document your intention at the time you do that. There was a Supreme Court case like decades or so ago where it was kind of saying, hey, document while you're alive. And if you're saying this is mom's place, if mom sold it, it was all her money, then yeah, definitely a bare trust. Long-winded answer, sorry.
No, that's great. I think that provides a lot of the nuance that we need around that situation. And then the last thing here is just that Heidi had wrote me and said that she had to take a call. So on the RESP question, she missed the answer. So Heidi, yeah, the answer was an RESP and other registered accounts like RSPs would not be a trust, is what Kurt had said at the beginning there.
Well, they don't have to file.
Or don't have to file, right?
Because if you think about it, the banks manage all those things and they're filing information returns with the government anyway. So all those registered accounts, I call them RIFs, RSPs, TFSAs, RESPs, all those types of things. No, you don't have to worry about those. No.
Great. Okay, well, I think that is all of the questions. Kurt, thank you so much for giving this information. There's a lot of really technical info, really important info, and a lot of this is coming up quick, particularly with the trust reporting requirements due within the month. So very timely. Again, all of this, the slides and the webinar recording will be available on OFA's website. The recording will be in our YouTube channel. I will put my email in the chat here. If there is questions or member concerns about this issue, any of the issues or any tax issue discussed, please feel free just to reach out to me directly if there's more you'd like to see OFA doing on any of these issues. So once again, thank you everyone for coming, and thank you so much, Kurt, for this great information.
Great. Thank you for having me. Have a great day, everybody. Bye for now.
Bye, everyone. Thank you.